So PE means price to earnings, and forward PE is the forward price to earnings. What these two numbers mean is that for every dollar of profit that Apple has made in the trailing 12 months, the last 12 months, you have to pay about $35.86 to acquire $1 of profit. So earnings are essentially just profit. In simple terms, say Apple earns $100 billion in income. You have to multiply that 100 billion by 35.86, and that's how you get the market cap. So the way you think of price to earnings is for every dollar in profit I'm buying, because again, when you're buying a share of a stock, you're buying ownership in a company. So for every dollar in profit that company makes, an income that company makes, you are paying, in Apple's case, just under $36. So that's kind of the premium. And that's for the last 12 months. Forward PE is for the following fiscal year. So companies, all public companies, come out with earnings forecasts and different types of guidance, right? Analysts do theirs as well. Obviously, it's impossible to know what the future earnings are going to be, what the future income is going to be, but there are projections. So in this case, you're looking at Apple. And 35.86 for the last 12 months, and for the future is 29.53. So for every dollar of profit that Apple is planning on generating in 2026, you would have to spend 53 cents in order to acquire it. Again, so just think about it this way. A company does $1 million in profit. It's worth $10 million. That means its price to earnings is 10. Company does $1 million in profit. It's worth $50 million. Price to earnings ratio is going to be 50. So that's what PE means. And I think this is one of, if not the most important number to focus on when it comes to investing, because fundamentally you're buying ownership in companies. And I repeat this over and over again because I think like that's really just the most important part to understand. And when you're buying ownership in companies, you're buying current revenues, current profits, the current balance sheet that includes debt. You're buying into all these things. So you want the company to make money. And typically you'll see companies have trailing 12-month price to earning ratios lower than forward price to earning ratios. And the one really important thing to know about the forward PE is that this number isn't guaranteed. This number is accurate to the point that all these companies get audited by public accounting firms and all this stuff gets validated. The forward PE number, this is something that, again, they're not making up, but it's speculation. It's estimation. It could be totally wrong if something goes wrong in the next month or 5 months or 6 months, or, there's a supply chain issue, or there's an issue with the product or service. So always important to understand that this number, although generally in the right direction, is not going to be 100% accurate. And that's just the way it is.